on investments. Okay, chapter 16. Okay, last chapter. Again, this last half of the class has been just chapters 6, 7, 8, 9, 12, 15, and 16. I never get it. As soon as I start talking about the material, somebody always gets up and walks out. I don't get it. I mean, isn't this the point of our meeting? Okay, well, I guess if you got to go, you got to go. Okay, so what's happening? Chapter 6, 7, 8, 9, 12, 15, and 16, okay, are going to be on the final. No chapter 10, no chapter 11, no chapter 13s and 14s. 10 and 11 were the business plan chapters. 13, 14 went on more about marketing. I think we got enough coverage of marketing when we were sitting there in the discussion on we were sitting in a discussion for chapter 12. Okay, so I think we're in good shape there. Just making sure I didn't lose the connection on the mic when I stepped out there. So let's go ahead and let's take a look at this last chapter dealing with investment opportunities. Okay, and when we talk about investments, we talk about them in the context of investing in debt securities versus equity securities. Debt securities, things like bonds, pretty much for investment purposes. Equity investment being what? Stocks, right? Okay, so we come over and we talk about, and this is a little hard to see on this slides. I don't know why they use these weird colors that don't have a good way to see them. But we're talking about the type of risks and rewards that you look for in investment. The more the risk, the higher the return. Okay, and if you get to the most risky investments, we're talking about investments in things such as junk bonds, aggressive growth stock. When we get to more risk, more chance that you will lose your initial investment. Okay, and of course we don't want to lose our investment. Does that help at all? That helps a lot, but then you can't see your paper. You want to do it like that? Okay. Okay, and so what happens? You sit here and you have your investments in, say, a risky bond. They call those junk bonds. Junk bonds aren't as prevalent anymore. Junk bonds were a big deal in the 80s. Okay, there was this individual named Michael Milken, and he was a guy that was the junk bond king. And the idea was that you could get these great returns if you just invested in these bonds of high-risk companies, etc. And of course, what ended up happening is the bottom dropped out of that whole thing, and a lot of people were harmed and lost money on that. So now, for the most part, any reputable investment house will not invest in junk bonds anymore. And most governments now have the requirement that government pensions, etc., or a county investment fund for a county or a state are not allowed to invest in junk bonds anymore. So these more risky items, pretty much the regulators have said no more. Okay? Uh-huh. Junk bond is basically a company that is issuing the entity that's issuing the bond is a very risky company, and they're in some sort of business that maybe is not going to necessarily perform as well, or they're a startup company or something like that. So to attract capital, of course, they have to offer very high interest rates. And for a while, everybody was like, "Oh, junk bonds, yeah, invest in those. The company's going to do fine." And it turns out that our formula for risk and reward was actually what we thought it was, and that if you invest in those things, the company goes under, the bond they default on the bond, and so people were losing their investments, etc. And so the famous case was Orange County. Orange County invested heavily in these junk bonds, and the bottom fell out, and it was a big deal. And after that, they passed legislation that, for the most part, like in a county, what county investment funds do is they take excess cash, et cetera, from different cities and stuff, or maybe a school district within that county, and they invested on behalf of those entities in their county. And, you're not supposed to play roulette with that money. And essentially that's what they were doing with these junk bonds. And Orange County lost a bunch of money. It was a big scandal. And after that, that really kind of brought to light how bad, well, actually before then, everyone started to realize how bad junk bonds are now. So most reputable investment houses, they don't allow you to even invest in junk bonds. Okay. Most investors want to be in this green area, okay? These are what? Blue chip stocks. Blue chip stocks are companies that have a long tradition of having good return on their investments. For example, an oil company, Chevron, is going to be a blue chip stock, okay, that you can invest in. Okay, stocks with moderate yields, bonds with moderate yields, large corporations, these sort of things are all considered moderate. Low risk bond mutual funds, government bonds, state and local government bonds are considered low risk. And then no risk really with your cash, your savings accounts, a little bit of risk with money markets. Why is there no risk with your savings accounts? You have money in a bank. What happens if the bank goes under? No. You have a deposit in the bank. What happens if the bank goes bankrupt? You can get your money back because the Federal Deposit Insurance Corporation, when you walk into a bank and it says FDIC, that means that those deposits are backed by the full faith and credit of the federal government up to $250,000. If you have more than $250,000 invested, then FDIC won't cover it at that bank. So what do you do if you have more than $250,000? Deposit it in a second bank, and then that bank is covering your deposit up to $250,000. The bank isn't covering it, but the federal government is. Okay, federal government did this after the Depression because you started to have runs on banks where everybody was. You ever see the movie It's a Wonderful Life? No, you guys are too young for that. This time of year, look for that movie. It's a Wonderful Life. It's kind of a fun movie to watch this time of year. They always show it on like Christmas Eve on NBC or something. And in there, they talk about, how people were running on the banks and that kind of stuff. But people were going to the banks and saying, I want my money out. There was a little bit of a run in the financial crisis that we had here in 2008. You guys almost lived through it. But what they did was they came up with the Troubled Asset Relief Program. And what the Troubled Asset Relief Program said is, hey, look, we will back whatever is going on with investments and whatnot at banks beyond the FDIC insurance. And that basically, I don't think people realize how much to the brink we were. What the federal government did, one of the major things it did with the Troubled Asset Relief Program, is it basically said, look, continue to buy basically mortgage-backed securities, investors. Continue to buy those. And what we'll do is we will cover those securities that you buy. If they go bad, we will go ahead and we'll cover those. And so what happened was mortgage banks, different purchasers of mortgage-backed securities went ahead and continued to purchase those, and those kept the securitization markets open. The only reason you can get a mortgage is because whoever sits there and issues that mortgage turns around and bundles all those mortgages, sells those, and they create securities off of those. Fannie Mae and Freddie Mac buy those loans and packages, and then they create securities, and people come in and they buy those securities from Freddie Mac and from Fannie Mae, and that keeps the whole sort of system running. You drive around the Bay Area and you get up on a hill and you look and you see all of those houses that go on and on and on of beautiful houses. You should sit there and say, thank you, Freddie Mac, thank you, Fannie Mae, because the fact that they sit there and they're willing to buy those securities is the reason that you can have mortgages so people can buy all those houses, and all those houses keep the economy growing. If that had dried up because of the financial crisis and the problem with some of the mortgage that they got into, we would have been in a world of hurt. So they criticize the Troubled Asset Relief Program a lot. And the real interesting thing is now we're seeing that the government made money off of that, because by agreeing to back those and have a partial investment in those, as the growth has gone on, the federal government actually made money off of stepping up and doing the right thing there. Now, what I've heard, and I think it could be true, is with this. Remember I talked about Carrier air conditioner in here, and I kept saying, hey, Trump at least is making people aware of problems by mentioning Carrier air conditioning. And Carriers kind of saw it the same way I was. Man, we better work with this guy or this is going to look bad for us. And so Carrier now has agreed not to send jobs over to Mexico and keep the plant in Indiana. But part of the deal is that they would get a tax break from Indiana. And so they did get a tax break from the state of Indiana, and they're going to keep the plant in Indiana. Now, some people are criticizing and say, you see, that shouldn't be, because now every corporation is going to hold the government hostage for something like that. I disagree. I'm starting to think there's a potential that Trump will be the best Democratic president we've ever had. That's a Democratic move when you sit there and you come with the Democrats. That's the kind of stuff Obama did, coming in with GM and that kind of thing and keeping them afloat and giving them incentives to do things that help the U.S. economy. So, okay. So anyway, higher up the pyramid we are here, the more the risk, but the greater the return. I would say most investors want to be in here. Your age, you want to be in here. I don't recommend you ever get in here. I'm down here. Why? Because I'm old, and so I don't have a whole lot of time for things to grow. And so I want to get to the point where I'm going to want to make sure that I have the ability to harvest off of these investments. Two, I am ridiculously conservative when it comes to my money that I've earned. I either want to be driving a new vehicle, living in a nice house off of the money that I've earned, or I want to know that I'm not going to lose it. I'm not much of a gambler. I go to Las Vegas and watch TV, okay? So I don't sit there and gamble, okay? When all my friends are out gambling, I'm sitting there watching the game on the TV, and I rarely have any money on that game, okay? All right, so that's where you need to be. It really depends on what your risk appetite and where you are in your, investment horizons, okay? Okay, now, so they look at how you can sit here and allocate your investments, and if you're going to be more risky, where are we? Much more in aggressive stocks, a little bit in cash, okay? Much more conservative, sort of where I am. More in bonds, cash, treasury bonds, treasury bills, much less in stock, and I'm even less in stock than this. But you have these different levels, okay, in terms of your mix. Okay. The agency that oversees buying and selling a stock, that wasn't on the slides, but I'm covering it here. It's the Security Exchange Commission. They're the ones that oversee all of that, and I think we mentioned that last time when we talked about interstate commerce, and this is how the federal government gets involved. The Securities Exchange Commission was created off of the 1933-34 securities laws, and it came in after the Depression, and there was a lot of questions about how these different investments were handled, etc. SEC was brought in to police and regulate that activity. Which of the following has the lowest risk? Treasury bills. Treasury bills have no risk. Full faith and credit of the federal government behind that, so there's no risk associated with Treasury bills, right? Unless the federal government defaults on its debt. Will the federal government default on its debt? It better not, but I don't know. Okay, as crazy as these guys are these days, I don't know. The debt ceiling comes up in March, right? And I don't know what's going to happen in March, because every time we got up to the debt ceiling while Obama was president, they made the man drag himself through the mud to agree to all kinds of things that he didn't want to agree to, just to do what they had to do, which is what? Raise the debt ceiling so that we could continue to finance the government. What's stupid about putting a debt ceiling up is that they already passed a budget, an appropriations budget, that precluded that they were going to have to exceed the ceiling, and then they made Obama do the political thing of dragging himself through the mud to beg them to increase the debt ceiling, that they had already passed a budget that had to make them increase the debt ceiling. They played that game with him for 8 years. It's going to be interesting to see what's going to happen when Trump's president and it comes up in March. There's one of three things that can happen. They'll make him drag himself through the mud, and he will increase it. Two, the Democrats will be nice and they won't do what the Republicans did to Obama and make him drag himself through the mud, and they'll increase it. Or three, they'll default. Okay, and I'm worried about three a little bit, because three was sort of unheard of before, whereas as crazy as things have been in this last year, I don't know. I get a little nervous.
What's the difference between a government bond and a treasury bill?
Treasury bill, oh, you see that on this question? Government bonds could be a treasury bond. And because a treasury bond, the way that they have bills, notes, and bonds. Bill, the life, treasury bill, the life is doesn't exceed, it's either 1 year or 6 months. I forget which. That makes it a bill. But it's very short term, so less risk because you're going to get your money back pretty quickly, right? And so you don't have to worry about changes in interest rates over that time. So less risk for a treasury bill. A treasury note is, I think, a year or more. I'm not sure how that 6 months versus a year works. But a treasury note is more than a year, but less than 5 years. Okay, and then when you go to treasury bonds are 6, and they go all the way up to 30 years. Okay, and mortgage rates are typically tied to the 30-year treasury bond rate. Okay. And those are driven off of what the Fed does when they make their decisions. Remember, we talked back several chapters ago when they make their decisions regarding the federal funds rate and some of those other things. They're set to decide, I think it's December 21st or something, they're set to decide whether or not they're going to raise interest rates. I have a feeling for the first time in several years they are going to raise interest rates here in December. The Federal Reserve Bank is. And the reason I think they're going to raise the interest rates is that if you have a situation coming where Trump is saying he's going to invest all kinds of money in infrastructure, and so that's going to create jobs. And so you're going to create jobs during a time when our unemployment rate is like almost considered at full employment, about 4.9%. Okay, and so what happens is as you get to closer to full employment, to keep the government for the inflation from overheating, the Fed will raise interest rates. And Janet Yellen, who's the chair of the Fed, has already started to talk about that she's thinking, she's signaling that they're probably going to raise the interest rates. I'm worried about that because the last time the Fed raised interest rates, that ushered in the housing crisis, because as soon as you raise interest rates, that does what? That makes houses more expensive. So people are saying, I can't afford that much house. If people aren't willing to buy those houses, our supply and demand discussion, that drops the prices of houses. And that's what caused the collapse to a large extent in 2008. So I'm a little nervous about how that's all going to play itself out. Now, one thing is they say that the unemployment rate is so low because there's a lot of people who stopped looking for work. We'll see, okay, if that's the case, because I asked the question to myself. They always say that it doesn't count the people who aren't looking for work. So we're to understand then that these people who have essentially stopped looking are all of a sudden going to dust themselves off and start looking for work because now we've created more jobs working on infrastructure or something. I don't know. Remember, we had different types of unemployment, right? We had what? We had cyclical, which we're not in a cyclical phase that's causing unemployment right now. We had structural unemployment where there's changes. I think much of what we have is structural unemployment, and that the type of jobs that were employing people before, particularly those people that voted in the what they call the Rust Belt in some of those areas, those individuals are facing structural unemployment, and that the broom making business just isn't viable anymore in the United States. So I think if we were to provide more type of job training, but part of what Trump's going to try to cover is he'll put infrastructure projects in those areas that might put those people back to work. Frictional unemployment, seasonal unemployment. So maybe something can be done in that structural area a little bit, but I don't know how much more employment we can get going the way things are. And as you start to heat up the economy too much, that's when the Fed raises interest rates, and that could end up being scary. We're also, I think, now on the verge of inflation. And so you could have a potential twin towers of problems with the economy that we haven't faced since the 70s, which is high interest rates and high inflation, and that can really freeze up the economy. So some problems there, but we'll see. Maybe they'll work this whole thing out. Okay. Is having a variety of investments in your portfolio of different types of companies in different types of industries. Diversification. Okay, you don't want to put all your eggs in one basket, essentially. So you don't put all of your investment in one company. You don't put all of your investments in the oil industry. What happens? All of a sudden the oil industry tanks, and you're sitting there and you're like, oh boy, now I lost all of my investments. So you put your investments in different types of industries, different companies. Okay. An asset allocation that is 95% stock and 5% bonds is considered what? Is considered aggressive, right? Okay, more stability in bonds, and then again, the higher you get up on that food chain, or I guess the lower you get on that food chain of risk, the less risky, the less aggressive your portfolio is. Okay. Issuing securities in the primary market, we have investment bankers. Investment bankers are usually the ones that take down the initial public offering of a company. They take that entire offering, and then they go ahead and they sell it to you in the secondary market. So as far as the company's concerned that is initially going public means they're going to be issuing stock for the first time. They issue that in an IPO. For example, you probably remember Facebook a little while ago had an IPO, an initial public offering, and what happens? That is usually taken down entirely by a broker, and then in the secondary market, you go to a broker such as Charles Schwab or somebody like that, and you buy those stocks and trade those stocks in the secondary market. A prospectus is something that is put out for an initial public offering when you're initially going to offer that stock, where they talk about the opportunities for investments, etc. But at the end of the day, you buy that IPO from an investment banker, from an underwriter. They have different names for these investment bankers that take down the initial public offering. Okay, when we have stocks, we have a couple of different stocks you can invest in. You can invest in a common stock. Common stock is a voting stock. So if you want to have a say in the decisions that this company makes, that is called common stock, and you get a vote annually at the shareholders meetings to vote in the boards of directors, etc., who then hire the management of the company. Okay, now you have preferred dividend. Preferred dividend has no voting rights. So why do they call it preferred? It's preferred because the preferred stock gets paid out any dividends before the common shares obtain any dividends. So if the company doesn't call a dividend in year one, there's a type of preferred stock called a cumulative preferred stock, and that dividend will accumulate in year one. Say 5% of whatever the face value is of that preferred stock, and that'll accumulate in year one, even if they don't declare it in year one. Year two, let's say they finally declare the dividend in year three. At that point in time, the preferred shareholders would get what? They'd get 15% off the top for their share of the dividends based on how many shares they hold on the face value of their shares. And then what? They get their 15%, and then any money that's left for that dividend does what? Will go to the common shareholders. So the common shareholders get paid what? After the preferred shareholders when a dividend is declared. So that's why people want the preferred stock. Preferred stock is usually what? Usually more expensive though. So if you want to get and make some investment in stocks, it's a little easier to get the common stock. You have the voting rights, but when it comes to dividend distribution, you are behind what? The preferred shares. Okay. So we have different types of stocks, and we've already kind of seen some of this. Blue chip, companies of historic consistent growth. Growth stocks are usually for companies that are experiencing rapid growth. For example, a technology industry. Maybe green company stocks these days are considered growth stocks, but we are not sure if that trend is going to continue, right, as opposed to a long history of growth from a blue chip stock. Okay, cyclical stocks are issued by companies that produce goods or services that are affected by economic trends. Entertainment stocks are considered cyclical, and they actually go opposite the market. They sit there and they say, hey, when times are bad, entertainment stocks actually go up because people need an escape from, some of the bad things that may be happening in the economy, etc. Okay? Defensive stocks are stocks that you buy when you're just trying to hold your position, thus the term defensive stocks. For example, stocks in what? Food companies, okay? Stock in grocery stores, farming corporations, that sort of thing, because we know we got to have food, right? And so we know that we're going to hold our position with those stocks regardless of the state of the economy. Income stocks are issued by companies that pay large dividends, such as utility companies. So if you want to invest in PG&E, you know that PG&E is going to have a, no pun intended, steady current of what? Revenues coming in. I guess the pun actually was intended. A steady current of funds coming in, and then what? And then they're going to be able to pay dividends on a pretty regular basis. So that's considered an income stock. You would probably invest in this if you were a little older investor. Okay, valued stocks are ones that you think that what? Even though they won't be paying out dividends, we will see a continued growth in the price of their stock. Apple is probably one that's considered a value stock, and that we can continue to see the value of Apple stock going up over time. Okay, so all of these are different types of investments you can make. So even though you may be you may be in that whatever percent stock, within that percent stock of your portfolio, you can actually sit there and pick different types of stocks to be invested in. And again, it has to deal with your risk-reward appetite, where you are in your life. I'm going to probably be more in this place. You're probably going to be more over here, maybe more over here. Okay? But if you're sitting there and you're in a gambling kind of mood, probably you're a little bit more over here. I mean, to a certain extent, trading in stock is gambling to a certain extent, isn't it? And that you don't know how this pendulum is going to swing. Okay. I listen to sports talk radio, and there's one guy on there that talks about sports investing, and he basically says, hey, I'm investing, and he puts money in and he decides what teams to bet on and that kind of thing, and he says that's investing. He calls it sports investing. Of course, this is not considered something that we would consider typically investing, but again, just to point out the connection between investing and gambling. Okay, so when you choose those stocks, again, it depends on your investment goals and objectives, time available to achieve the goals, right? The longer horizon you have, a little bit more risk you can take, but it's also your risk tolerance. I mean, I've been in the old man stage of my investing for a long, long time just because I am afraid to lose money, but I also don't like to gamble either. So, one of the big reasons I don't like to gamble is what? I hate losing, okay? And so I don't want to be reminded that I lost every day if I put money in a certain, thing that's going to lose its value. So, okay. Okay, good. Different exchanges, New York Stock Exchange, the NASDAQ is usually for smaller stocks, more technology-driven stocks, less financial institutions, that sort of thing, not PG&E, so a little more on the growth side of the type of stocks as opposed to the defensive stocks and the blue chip stocks are going to be contained in the NASDAQ. New York Stock Exchange is going to be more of a cross-section of stocks. Okay, and then over-the-counter is for very small companies where essentially you issue the stock to the broker and then the broker goes ahead and issues the stock to the individuals. Did I put this slide up before? I thought I did. This was me in China, and we were talking about the SEC there and how you can take the U.S. CPA exam. Remember I talked about teaching for the CPA exam? And you can see how fascinated everybody is. This is in the discussion here. And basically what I was talking about is taking the U.S. CPA exam overseas, because what's happening is more and more individuals are interested in taking the U.S. CPA exam in Asia and in the Middle East. In Asia, particularly because a lot of Asian companies now are wanting to be listed on the U.S. stock exchanges, and the SEC is telling them, well, look, if you're going to list on the U.S. stock exchange, we need to know that your staff understand U.S. generally accepted accounting principles, and one of the ways they're demonstrating that now is by taking the U.S. CPA exam. Okay, but I point this out because it's not just U.S. stock exchanges. There are stock exchanges all over the world. I think when we talk about stock exchanges, we tend to think about just the U.S. stock exchange, but there's one in Shanghai where this picture was taken. There's one in Tokyo. The Nikkei is in Tokyo. There's all kinds of stock exchanges all over the world that you could also invest in. This guy was traveling with us, and what was interesting here is he kept holding up a sign telling me to slow down, meaning that I was talking too fast for, English as second language individuals to understand. And I'm like, hey, I talk fast and then I stop talking. I don't really have a slow mode on talking. But anyway, okay, so how does this work with these stock trades? And the way they're showing this is maybe the way it's working in 1950, where somebody would call and they would call the broker or order the stocks. The broker would then reach out to a floor clerk. They would acquire the stocks, and then the floor trader would call the broker back and say, okay, here's the price. And the broker would call you back and say, okay, here's the price. It doesn't work this way. All of this is done what? All of this is done over computer, right? You go and you look and you see what the price of the stock is. You hit a buy button and the computer talks to the next computer and that talks to the next computer until finally we have what? We have a purchase for it. It almost happens instantaneously these days, or at least within 24 hours. So this is sort of the old-fashioned mode. The interesting thing here is that because so much of this is automated, that when stocks hit a certain price level, okay, what happens now is the computers will automatically decide to sell a stock if it hits a certain price point, And that caused a crash of the stock market in 1987. In that, what happened? Once the prices got down, the computers, it was almost like Terminator. The computers took over and started doing what? Started selling all of the stocks, and that caused the market to continue to drop. Now, my recollection is that the stock market dropped 500 points that day in 1987, and everybody said, it's a crash. To drop 500 points. I mean, relative to where it is now, we don't drop 500 points in a day. That's still considered a pretty big drop if we were to drop 500 points in a day. But no one starts using the C word on that it's a crash. So the number of points that it's dropped is relative to how high or how low it is at any point in time. But it definitely was a problem that the computers were doing these automatic sell-offs. So what they did was they put a cap on that in the event that the stock market drops a certain percentage, they cut off those automatic sells. They basically turn off automated trading at that point in time. And so everybody kind of takes a second to cool down. They don't let the computers take over. And when the market opens the next day, that's why you frequently see a quick recovery after a drop, and we don't get go into the tank on all that stuff because of the computers trading everything. Okay. Did I put this up before? I can't remember now. This is how you would read on Yahoo Investments, or if you're looking at the Wall Street Journal or something stupid like this. We're looking at Nike stock, okay? And the high was 78.55, 48.76 within 52 weeks. 52 weeks is a year, right? So over the year to year, this was the high and the low. This was the volume that was traded for this day. This was the high on this day. This was the low on this day. This was the close, and this was the net change in value from what? From the time the stock exchange opened this morning for that stock and when it closed that day. Okay, so this is giving you a way to look and read these. Okay, and so the prices obviously do what? Obviously change over the course of a day. In the course of a year. I guess this is a year. They change over the course of a day. So we saw here, they change over the course of a year, right? Okay, now stock performance, okay, can be just based on supply and demand, based on what people are perceiving or going on. Sometimes you'll hear, hey, I got a stock tip for you. Okay, those things are going to drive supply and demand. Basically, based on economic forecasts, etc. The companies have what they call conference calls. They have quarterly conference calls in which they invite in all of the stock raters, Standards and Poor come into those, different financial press come into those, and they basically go through their earnings reports, their quarterly earnings reports, and they talk about those future things that are going on, sort of talking through, explaining, etc. And so a lot of what happens with these stock prices will be based on those quarterly reports, those quarterly conference calls. Now, what I found interesting, I was on an assignment with the GAO looking at how companies, how the U.S. sets its stock price, sets its accounting standards, I should say. And with the accounting standards, one of the things we wanted to understand was from the perspective of the users of the financial statements. That would be companies like Standard and Poor, et cetera, that are making decisions about how stock should be rated and whatnot. And one of the things they told us is that if they were to recommend to investors that they sell a stock, and they listed that stock as a sell stock, that they will get frozen out of the next conference call. They won't be invited to the next conference call. And if they're not on that conference call, that affects their ability to do their job, to talk about how stocks are performing, etc. So what they told us is they take a position that even though they may think that you should sell a stock, they'll say, hold that stock. If they think that you should hold the stock, they'll say, buy the stock. So there's always a little curve that's put in there just so that they keep the companies happy, so that the companies won't think that they are sitting there and giving a poor report on their stocks. So you have to be a little bit careful in how you read some of that news, etc. But all of these things will affect stock prices, particularly their financial performance. So we end up with two types of market here, a bull market and a bear market. A bull market means that everyone is believing that the stock prices are going up, and so we're going to want to invest in stock. Bear market means that everybody thinks what? Thinks that the stocks are going down and this is not a good time to invest. The easy way to remember that is when a bull fights, a bull does what? It lifts its head up to fight. When a bear fights, a bear does what? It swats down on its opponent, right? So bull market means what? Things are going up. Bear market means you think things are going down. Okay? Okay, good. Come over and let's take a look at stock indexes. Okay, what these stock indexes do is they go ahead and they put together a group of representative stocks, and then they will show how the representative stocks have moved, and basically that's how we think the overall market has moved. And so we have Standard & Poor, which has 500 companies. That's why they call it the Standard & Poor 500. The Dow Jones Industrial Average, I want to say it used to be like 30 or 50 stocks they had in there. And then you have the NASDAQ 100. Okay, and these stocks are supposed to be representative of the market. The one you hear the most is the Dow. When you hear the ending close, etc., you'll end up hearing what the Dow Jones Industrial was. That's what they quote a lot of times. But you have these others, and sometimes if you look in the financial press, you'll see what? You'll see a table that will have all the different ones, or you'll see that on the news at the end of the night. If you walk in downtown San Francisco, out in front of Charles Schwab, they're rolling all of these during the days. You see how these industrials. So they obviously, don't list every single stock there, include every single stock in there. It's just a limited number of stocks that are supposed to be representative of the market. Now, you'll sometimes see the ticker tape. If you walk around New York City and you walk past certain buildings, they'll have that ticker tape rolling, and that's listing what? That's listing every stock and where their price is at any point in time. But these are averages that index. Okay? And then you can buy into, and we're going to talk about mutual funds, etc., that attach themselves to these indexes. And so how your investment performs is tied to how these 500 stocks, these 100 stocks, whatever, perform. Okay? Now, it's important to note, and I think I had looked for this slide last time. I was trying to put the lecture up this last weekend. I heard myself saying, where's that slide? And this was the slide I was looking for. I thought I put it in chapter 15. I put it here. But remember, we talked last time that if there is a liquidation of the company, who's first in line? The accountants and the attorneys are first in line. Then what? Then the taxing authorities, then the employees. But after all those people get paid out, creditors get paid before what? Before the stockholders do, right? So for that reason, we'll see in a little while, you may want to invest in stock, okay? I mean in bonds rather than stock if you're more conservative, okay? Because you're going to get paid before the stockholders do. Okay, so the first time I come any issue stock, it does so through an initial public offering IPO, right? Okay. Which of the following is least likely? Which of the following would be least likely to buy stock in an IPO? A institutional buyer. Which of the following is least likely to buy stock in an IPO? An individual investor. No wonder that didn't make any sense to me. So why would it be an institution? They're the ones that do what? They buy the IPO, right? And these large investment bankers, etc. Okay. Okay, blue chip stocks are issued by companies that have a long history of consistent growth and stability. Okay, A what? Comes from a company that makes consumer goods. That's a defensive stock, right? That's a defensive stock. Okay. And then an investor with a strong appetite for risk should purchase a growth stock. 27, an investor who wants a fairly reliable and large dividend would be served by buying, that was the income stock. A bear market is distinguished by a declining stock market, right? The bear fights by swatting down, so things are declining. Bull market means that we are having an increasing stock market. With stock investing, when does capital gain occur? Capital gain is when the price of the stock goes higher. Those are growth stocks, right? That over time we're going to see that they're going to continue to increase in value. Is that our growth stocks? I think I misspoke there. Growth stock is what? Value stocks, excuse me, are the ones that grow in value over time, right? Value stock, not growth stock. Growth stock is rapidly expanding, whereas a value stock is growing, but it's not as much as of the rapid growth. Okay, let's quickly go through these bonds because we still have to take the evaluation, guys. And so let's just quickly look at bonds. Okay, characteristics of bond. Basically, you're going to get periodic interest payments off of a bond, probably every 6 months. Okay, so you have a steady stream of income coming in. And again, we've talked about treasury bills, treasury notes, treasury bonds being of the least risk. Municipal bonds, okay, have a little bit more risk associated with them. Do cities ever go bankrupt? Ask Stockton if you don't believe if a city goes bankrupt. So cities can go bankrupt, and so there's a little more risk there, but not quite as prominent. Tips are basically what they do is they take the treasury securities, but they do put an inflation check on that. Okay, and then we have corporate stocks, where corporations will issue their stocks. They're probably the most risky of these that are up here. Okay, so we look at different things. What is the credit risk? What is the inflation risk? Market risk? They talk about legislative risk here, and they talk about the taxability of bonds. And I looked at that, and I'm like, yeah, right. I mean, look. Municipal bonds are not taxable at the federal level. So people like to invest in those because what? You don't have to pay federal tax on a municipal bond. So if you buy a bond, the state of California, buy a bond from the city of San Jose or something, whatever, those bonds, are not taxable at the federal level. And what this slide, I think, was implying is that somehow there could be a change in legislation that will start taxing those. That's not going to happen because the Constitution says that the federal government can pass no law that will interfere with the revenue generating activity of state and local governments. And so if they did all of a sudden start taxing the municipal bonds, that would be akin to doing what? To interfering with the revenue generating making activity of state and local governments, unconstitutional. And the only way to make that constitutional would be to amend the Constitution. How do you amend the Constitution? You have to go to what? The state legislatures, and you have to get a 50% vote in favor of that amendment in 2/3 of the state legislatures. Why would the state legislatures agree to pass a change to the Constitution that essentially interferes with their making activity? So that's not going to happen. So I don't even know why they bothered with this legislative risk. There is absolutely none, in my opinion, and I think I got a pretty strong position there. Okay, so you come over. There's different ways to rate the bonds. Okay, lowest risk here, and then more risk here. What was really stupid is Standard & Poor's changed the rating of Treasury securities from a AAA to a AA status, which was a really dumb move. I mean, this was pure politics because of the debt ceiling fight. They went ahead and moved it from here to here, and I'm like, why bother? If the if the federal government defaults on its debt, just burn this whole thing. I mean, there's nothing that matters anymore at that point in terms of how we usually think about investments. So that was just politics. It wasn't Standard & Poor's. I think it was Moody's that did this. Okay, and these are similar. There's no standardization here. They just do it however they feel appropriate. Okay, okay, good. When do bondholders, what reward do bondholders get? It's what? Interest payments, right? Okay. If you want a bond that you can exchange into a stock, that is called we didn't cover it in the slides, a convertible bond. You hand in the bond and the company gives you the stock back in return. Okay, that's called a convertible bond. Okay, which of the following bonds has the shortest maturity date? That's our what? Treasury bills. I think they go up to a year. Our notes are a year to 5 years. Our bonds are 30 years. Okay, which of the following bonds has the longest? It's what? Which of the following is Treasury bonds? Which of the following is the safest? Is what? Treasuries, right? Okay. I'm going to stop there, guys, because we're flat out of time. You'll see there's a few slides talking about mutual funds. All mutual funds do is they sit there and, what did we lose? The electricity here? Okay, here we go. All the mutual funds do is you go ahead and you give your money to a mutual fund, and then the mutual fund goes out and does what? Makes all of those decisions as to what stock should be held in that mutual fund, and you can achieve diversification through a mutual fund. Okay? Who wants to help with the evaluation process here? Somebody has to give these to you. I am not allowed to administer this. In fact, I'm going to be wrapping up. I'm supposed to leave the room while this happens. Do you want to do this? Can you take it to FP21 after class here? Right down the hall? Okay, so go ahead, distribute it. Everybody fill it out. Give it back to her. She'll put it into the envelope and then take it over to Dean Bueller, okay? Huh? No, you give it to the students right now. You can stand up, give it to the students because we got to hurry up and do this. And then you guys fill it out. You give it back to her. You take it to FP21 over to Leslie Bueller, or Sela is over there. You might be able to give it to her. Okay? All right. Whoops. Where are you going? No. No, come back. After. They have to fill it out. Yeah. Right. No, that's okay. Okay, so you give it to them, they fill it out, and then you take it over there. Okay. Sorry, guys, I have to stop this thing. I'm not sure what the range of it is. I don't think you want to hear me go to the bathroom, so.